Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories now we're following in the BNN Bloomberg newsroom. Canada recorded a trade deficit for 2025 of $31.3 billion. That's the widest annual shortfall on record, excluding the pandemic. Data from StatsCan shows annual exports last year saw a decline, but exports of gold, silver, and platinum jumped nearly 42%, driven by a run-up in metals prices. Meanwhile, exports to the U.S. fell 5.8%. Shares of MTY Food Group are trading higher, about 4.5% right now. The food court restaurant company posted adjusted profit in its fourth quarter that beat estimates. Revenue also rose 7% and topped expectations. The increase was driven by growth in franchise operations as well as its distribution and retail segment. MTY says macroeconomic conditions continue to create short-term headwinds, and it saw weaker sales across its U.S. and international networks. Shares of Molson Coors are down about 6.6%, 6.7% after the company posted lower than expected profit and sales in the fourth quarter. Molson says the sector continues to face significant headwinds as consumers tighten spending and younger generations show less interest in drinking. On top of that, increased aluminum prices have also taken a toll. Moving forward, the company is looking to grow its premium beer brands. Taking a look at the markets right now, the TSX clinging into the green, right, just barely. It's been slowly losing that lead all day. Still up by 0.07%, almost a wash south of the border. Everybody's in the red down there. The S&P 500 off by 0.6, the Dow by 0.8, and the Nasdaq by 0.62%. Well, the S&P continues to recover as technology stocks rally after a turbulent stretch. My next guest says we are seeing a growing divergence in credit spreads across sectors exposed to AI disruption. For more perspective, I'm joined now by Adrian Young, SVP and Director in Canadian Corporate Credit Research at Franklin Templeton, and a Team Canada hockey fan. Go Canada, right?
Yeah.
All right, let's talk some of the numbers. You're talking about the divergence in credit spreads. Where are we seeing that the most?
Thus far, we aren't really seeing it in Canada. We are seeing it in the United States. We saw, for example, some of the insurance brokers widen out by, I think, 10, 12 basis points last week in the U.S. We're getting these headlines fairly regularly lately, and they are creating a bit of dispersion, finally. Mm-hmm. What we're anticipating here is that this is going to bleed into more into more sectors of the Canadian economy, and we're going to begin to see that dispersion in Canadian credit spreads as well.
Where are you expecting to see it to bleed into in Canada?
Well, we don't have a big tech sector here that we can invest in on the credit side. We do have some retail names, and we may see some there. The banks will see various effects from AI, and the effects of AI can be positive and they can be negative. For the banks, you might see lower expenses, especially back office expenses. The insurance companies may see a little bit of movement. The real physical assets, I think we're going to see less exposure in the immediate term. The pipelines, the oil and gas companies, the utilities, we may see some positive movement there, because as AI grows, so does demand for energy, so does demand for electricity. And so they'll be issuing more, but they'll also be dealing with changes in supply-demand equation.
And so how are you treating this? Where are you putting your focus right now?
Well, right now, credit spreads are very tight. And there is not a lot of dispersion. So we're taking this opportunity to be very thorough in our credit work, thinking about what names we like, where the best quality credits are. We're being very picky and choosy. We're also still thinking a lot about the dispersion in economic outlook between Canada and the United States. Canada, as I said, doesn't really have a huge tech sector. The US is investing very rapidly and very aggressively in its tech sector. That's generating jobs. It's generating the potential for improved productivity, whereas our productivity numbers are not so great. And we don't have shovels in the ground on our national priority projects yet. We don't have a lot of foreign direct investment in Canada yet because foreign investors are looking at our relationship with the United States and the uncertainty around the CUSMA negotiations coming up this summer. And so they're sensibly waiting it out. So we're anticipating that the US is going to outperform Canada on the GDP front, and we're looking for opportunities to play that within the U.S. credit universe, engineering and construction. I think I mentioned last time I was on. That's still very interesting.
Okay.
U.S. banks are likely to outperform Canadian banks, we think, not because Canadian banks are not very solid. They are. It's just that you have a healthier consumer in the United States. So they're going to be slightly better write-off numbers, slightly better provisioning numbers. And that leads to slightly stronger earnings numbers and better capital generation.
All right. Well, we'll have to wrap it up there, Adrienne, but thank you very much for joining us. We appreciate it.
Thank you, Roger.
Adrienne Young is the SVP at Franklin Templeton. Up next, Equinox Gold jumps after higher fourth quarter earnings. Darren Hall, the CEO of Equinox, will join us after the break. Canadian gold producer Equinox is surging today after beating estimates in the fourth quarter. It also declared its inaugural dividend. For more on their future plans, joining us now is Darren Hall, CEO of Equinox Gold. Darren, thanks very much for joining us.
Roger, thank you, and appreciate you taking the time.
Let's talk about that first dividend. What brought it about this time, and how long can you see this continuing?
Yeah, no, it's been a journey over the last 7 years to get us to the position to announce the inaugural dividend today, and it's off the basis of a significant deleveraging program over the last 6 months. Since the completion of the merger with Calibre in June, we've taken the company from approximately $1.4 billion US in net debt to ending January at less than $100 million. So, with positive gold price, with ramping up 2 Canadian assets, we see strong cash flow from operations, significantly deleveraged. So, hey, thought it was an opportune time to start with initial dividend. And, it's part of a longer term approach to returning capital to shareholders.
And at 0.015, is that where you'd like it to be? Would you like it to see more, or can you see it growing through the next little while?
No, I think it's a start of. It's a start of a journey to increase that return to capital to shareholders. I mean, we've got some fantastic organic growth in front of us, and given the buoyancy of metal price, the solid and reliable performance we see out of the operations, I think we can continue to fund the organic growth and look at increasing that return of capital to shareholders vis-a-vis both the dividend and we announced the application for an NCIB as well today. So.
And do you see that going forward? 5% of outstanding shares. Can you see that happening, or are you waiting for the right moment?
No, I think that we've applied with it with the full intent of being able to utilise that facility over the next 12 months. It's not a promotional gig. It's just, we'll see there's going to be opportunities where for whatever reason, we do see the opportunity to come in and buy shares in the market, particularly as we see ourselves undervalued with respect to a number of our peers. So, and when there's the days too, and we see a little bit of a kind of a slowing in the trade, we'll take the opportunity to pick that up.
And what would it take for that moment to happen to buy them back? You said a little bit of slowing in the trade, but what else would it take to convince you now's the time?
No, it's really it's a little liquidity position. We're in a good position from a liquidity profile. We're only early in. I mean, we've kind of made some pretty rapid changes here in the last 7 months, and we're putting in place these facilities, and we'll start to execute on this, over the next months.
Okay,
and now continue to ramp it up through the course of the year.
Sorry about that. And now you mentioned about organic growth. Where do you see that happening, and by how much?
Yeah, no, we have a kind of an almost an unrivaled organic growth pipeline, and particularly considering that these opportunities were identified a number of years ago when gold prices were much lower, but the company didn't have the capacity nor capability to be able to deliver those. Now, with the delivered balance sheet, with the organisation we have today and the buoyancy of metal price, it's setting up for a great 2027 and beyond. And specifically, we've got some organic growth in Canada with the expansion of the newly minted Valentine project to expand that capacity from its current 2.5 million tonne to 4.5 to 5, which we would intend to start that program this year. And then Castle Mountain in the United States, which is in the FAST-41 process, and we've been insured by the US government. We'll have a record of decision here in late 2026, which will be our next phase of growth. And the sleeping giant in the background, which is Los Filos in Mexico, which we're encouraged by the recent discussions we're having with our stakeholders in Mexico and some very positive change in sentiment there. So, no, we're in a very good position.
Any concerns in Mexico with what unfolded over the last little while with the kidnapping of those the mine employees down there? Not with, of course, not with you.
A terrible situation, and my heart goes out to all of those impacted, the employees, friends, and family, the Vizsla team. I mean, a very tragic thing. In every environment that you operate in, there's idiosyncrasies and things you need to be aware of. Where we're operating, we have good relationships with all of our stakeholders. It doesn't mean it's not without risk, as is every environment. But no, we don't see anything in particular of concern in where we're operating. But you need to be aware, and you need to ensure that above all else, you're maintaining very positive relationships with the communities you operate in and the stakeholders in and around them. So, no, I'm comfortable with where we sit at Los Filos.
And with Brazil, I mean, it was sold. Is everything all cleaned up now? Is it all off the table?
Yes, it is. I mean, it's the transaction closed on January 23rd, and we received $900 million, which immediately went into a significant delivering activity in terms of repaying some fixed loans that we had, and also reducing our revolver, our overdraft, if you will, which was a significant contributor to our deleveraging. So we're working through the transition out of the business with our partners at CMOC there as they pick up the operations and run forward. But no, it's the deal's closed, and we're moving on and focused on our Canadian assets, ramping up those, continuing our existing portfolio of assets in the Americas, and looking forward to these growth opportunities we see in the portfolio. And
that claim from the Bahia Group, what kind of an impact is that having?
No, there's a little noise in the background there with respect to, but we're very comfortable that we've transacted consistent with the laws and all of the environments our partners have as well. So we don't see a significant level of risk there, but there is a claim that we need to work through with a stakeholder to ensure that we do that respectfully and close out that chapter in. But the transaction is closed, cash is in the bank, it's been dispersed.
Okay, Darren, thank you very much for joining us today.
Okay, appreciate it, Roger. Take care. Thank you.
Cheers. Darren Hall is the CEO of Equinox Gold. Up next, Pan American Silver is surging after reporting record earnings. Michael Steinmann, president and the CEO, joins us after the break. Amidst the precious metal surge of last year, Pan American Silver posted record fourth quarter and full year 2025 results. The company expects to increase its silver output further and has hiked its quarterly dividend. For more on this, we're joined now by Michael Steinmann, President and CEO of Pan American Silver. And Michael, thank you very much for joining us.
Pleasure to be here. Thanks.
A good day for you all around. What was driving it? Was it simply silver prices going up that's driving that, or you found some organic growth there too?
It's really a combination. Very strong production. We had a record production quarter actually in Q4. Very strong cost control on top of it. And then, of course, metal prices did the rest. So as a combination, those are the strong results, record financials across the board. So really, really good quarter and very good year.
Now, any concerns with silver right now? It's been extremely volatile. How are you working with that volatility?
Well, don't forget the average silver price for Q4 last year was only about $58. So we're sitting close to 89 now, so way, way higher in Q1. So I'm very happy where silver prices sit. Of course, there's more volatility at its high prices. We see lots of swings daily, but our costs are in the mid-teens. So no worries at all. I'm very happy where it stands. We were a very profitable company when silver was sitting at $36, $35. Obviously, that's the reason why now you see these big windfalls, $1.2 billion free cash flow for last year, $553 million free cash flow for the quarter alone in Q4. So really strong results. And
with that free cash flow, what are your plans for it?
We have some growth projects that we are looking at. A big project in Mexico at La Colorada that we're going to build out that will add even more production in the future, and also a potential expansion at our large mine Jacobina in Brazil. So lots to do with it.
And with Mexico, I just asked the same question earlier. Any concerns with security and safety down there?
Look, we are very aware of everything, of course, that's going on in Mexico. We are working there for over 30 years, and we'll continue so on. Keep doing what we are doing. We have large operations there for many decades, and we'll continue to look at all the situation and monitor it. But yeah, no big concerns right now.
And we were just looking at your numbers. You're forecasting a 14% rise in silver output. How much is that expected to cost, and where is that going? Is the demand there that much?
Oh yeah, absolutely. I'm sorry, I just a bit of camera here. A lot of silver demand in the world. We are actually the 6th year of a deficit when you look at the silver side. A lot of demand for AI, for electric cars, for clean energy production, solar panels, etc. So about 65% of all the silver is used every year for industrial application. This will grow in the future, as you can imagine, will continue. And so hence, we see actually a deficit in the silver market now 6 years in a row, hence the big run on silver prices that we see now. Our growth that comes mostly from the new acquisition that we did last year when we bought 44% of a Mexican mine, Juanicipio, which is actually our lowest cost producer, or one of our lowest cost producers. So it will be a great combination again of adding additional about 14% of new silver production at even lower cost than what we had so far. So great combination again with higher prices this year.
And what's making that mine the most efficient?
It's the grade. It's a high grade mine. It's a brand new mine that we share. It's run by Fresnillo, and we are partnered there in the mine. And it's a very efficient mining method and a great ore body with very high grade. So that combination obviously makes it very low cost and very efficient production.
And just going back to the mention of the deficit, do you know how long that's forecast for, or how long you're forecasting a potential deficit running for silver?
Oh, I think that will continue for many, many years to come. Don't forget, silver is mostly produced as a byproduct from copper production or gold production, but because copper and gold prices are already very high, there's not many more new mines coming on. And it's very, very hard to have silver mines, primary silver mines like we are running. They're hard to find. They're very difficult to find and expand. And so there's not such a direct correlation. So if silver price goes up, not automatically more production comes along. So that makes it, quite strong. And I'm very positive. I think we're going to see more volatility in the silver price because where it sits, but I'm very positive on the price going down, the next coming years.
And with that volatility, how do you see the dividends going? You hiked the quarterly dividend. Is that something you could see continuing?
Yeah, 29% increase of our dividend. Actually, it's a third consecutive increase of dividend. Every quarter now for the last 3 quarters, we hiked the dividend. Of course, we are sitting on about $1.4 billion cash right now. That's growing very quickly. Happy to have the shareholders participating in that through our dividend. We paid about $230 million last year, and that will increase now with this increase. And I think, as long as metal prices are high, our dividend and our sharing of that cash flow with our shareholders will obviously continue.
And now you mentioned that one partnership. Any others in the works over the next little while?
Yeah, there's more projects we're working on for sure. It's a bit early to share them already with the market, but we're always looking around, always looking for great projects for additional high quality production, low cost, long lives. And, that's how the company was grown, how the company grew really from a kind of a small company when I started with the company to the current size. And we'll continue that theme going forward.
Okay, and we're just going to go in another direction, not really, but your thoughts on gold. Where do you see gold prices and demand in 2026?
Yeah, and look, we're actually producing quite a bit of gold as well. And so gold is important to us as well, not only silver. By the way, silver is not occurring on its own by geology. You find it with gold or with base metals. Hence, we produce all those metals as well. And look, I'm very positive on gold. You see a lot of gold buying from central banks across the globe, a lot of really debasement of US dollar. I think that will continue. We see very strong buying from those central banks. We still see a lot of activity on the ETF as well from obviously smaller and large investors in the gold for very similar reasons. And I think we will see very strong gold prices here going forward.
Okay, Michael, thank you very much for joining us.
Thank you very much.
Michael Steinmann is president and CEO of Pan American Silver. Coming up, Teck Resources posted a mixed quarter, but what's really driving the story is what's still to come. We'll break it down after this. Teck Resources delivered a mixed quarter. The stock is seeing some pressure despite earnings beating expectations on lower costs and steady improvement at their QB project in Chile. We are joined now by Craig Hutchison, Director and Base Metals Analyst Equity Research at TD Securities, to help break down the results and what they signal for 2026, which will be an interesting year for them. Craig, thanks as always for joining us. What stands out for you from these numbers?
Yeah, thanks for having me on the show. Yeah, we actually thought it was a pretty good print for the quarter. Earnings was a beat. Came in at $1.5 billion. Consensus going into the quarter was around $1.4 billion. There weren't a tremendous amount of surprises this quarter around. We already have the production numbers for Q4, so no surprises on the production front. The company also reiterated their guidance on the production for the next 3 years, so no big issues there. They gave some pretty positive indications that the QB mine is starting to operate a bit better now. It's starting to ramp up. It's starting to kind of get its stride. They feel confident that they can exit this year close to design. I think maybe one of the issues and where maybe people have some concerns or why the stock is weak today is the overall capital budget for this year is quite high. It's in that $3 to $4 billion range. So this year they won't be generating a lot of free cash flow at the current prices, just based on that spend. It should roll off next year. This is supposed to be a peak year from a capital perspective. I think that's maybe perhaps why some investors are selling stock today.
Is it looking like money well spent, that cap budget?
It's money they have to spend. There's some major projects they have to do. One of them is the Highland Valley extension. It's a project. It's a major pushback of the pit that'll extend the mine life into the 2040s. If they weren't spending that capital, the mine would effectively run out of ore by the end of this decade. So that's obviously money they need to spend. And the issues that they've had at QB for the last few years require a lot of work on the tailings management facility, which is what they're spending a lot of money on this year. So I think as you look into next year, you should see the benefit of the capital spend in terms of the production growth.
All right, and those lower than expected costs, how important were they for the beat?
They're kind of marginally important, I would say. I mean, I think a lot of the beat really came more from the kind of the top line. They had some very positive provisional pricing adjustments in the quarter. I think looking forward, the guidance for this year, there is potential to beat the guidance that they've issued. A lot of the companies out there are using, I would say, conservative metals, precious metal prices, but they're using precious metal prices that are below current spot prices. So if precious metals prices hold up and some of these byproducts remain very strong, I think you have the potential that they could actually beat their cash guidance this year.
And any concerns if we see a downturn in those prices, how much of an impact that would have?
Yeah, obviously it would go the other way. If we saw, prices for copper pull back, you're going to see an impact on the revenue and the margin side of the business. And also we see the precious metals and some of the byproduct credits, those prices retreat. That'll obviously put some pressure on their C1 cash costs for the year.
But also, I mean, it's something they can weather though too.
Yeah, their liquidity is in a really strong position. I think they're in a net cash position, like over $5 billion of cash and liquidity of over $9 billion. So they're in a very good position right now financially to weather the storm and certainly execute on their capital plan this year.
All right, and your rating as a whole, target price is $76. What's keeping you on the sidelines?
Yeah, so we downgraded the stock in mid-January. It was after a really strong Q4. The stock was up quite substantially when we downgraded it. It really is more to the fact that we think the stock could trade sideways as they ramp up the QB operation. There's also, I'd say, a little bit of uncertainty with regard to the timing of the close with the Anglo-American deal. We think that could happen in September, but there's possibilities that could get pushed out into next year. They still need a couple approvals from the South Korean government, the Chinese government. We just saw at the time, we saw better value in terms of some of the other names that were trading at a bigger discount to Teck. So I do like the long-term growth story at Teck. I think they are doing the right things. They seem to be gaining momentum here at QB. That was just more at the time a valuation call where we thought the stock might just sort of trade sideways.
And with the Anglo-American deal, is that just kind of humming along now, even though, and would it be a huge factor if it got pushed back into 2027, or is it something not a lot of people would be surprised at?
So when they announced it last year, they allowed for a 12 to 18 month close. So I think a 12-month close would put you around September this year. They've got most of the key approvals at this point. They've got EU approvals, Canadian approvals, US approvals. So most of the main jurisdictions, they're just waiting on, really, I think it's 2 at this point, South Korea, and just takes longer to get those approvals just based on returns from the government. And
just one last question, the latest on the Chilean mine?
Sorry?
The Chilean mine?
QB?
Yeah, is that QB? Sorry.
Yeah, sorry. The question
we were talking, sorry, one more time.
Sorry, what was it? The question was on QB?
Yeah, you mentioned about the cyclones and shipload. Did you touch on the cyclones and shiploader repairs? They're all complete?
Yeah, so they made a lot of progress in the last quarter. The ship loading repairs are now done. They've swapped out all the cyclones at QB. So that really, what that allows them to get a faster deposition rate of the sand, and they could basically build the tailings management facility raises. The ultimate goal really here is to have the tailings dam complete by the end of this year so that they can move to a permanent infrastructure. So the process will be much quicker in terms of future raises of the tailings dams. And that'll allow the upstream part of the process to match the downstream. And it's been, the bottleneck really has been on the downstream for the last couple of years. And by the end of this year, they hope to have all the issues with the tailings management facility complete, and then they can run the mill at its full optimal design capacity.
All right, we'll wrap it up there. Craig, thanks very much for joining us.
Yeah, thanks for having me.
Craig Hutchison is Director and Base Metals Analyst at Equity Research at TD Securities. Coming up, we'll speak to Mike Greenlee, the CEO of MDA Space, about the future of Canadian defense. That's after the break. MDA Space formally expanded its operations with the creation of 49 North. The subsidiary will focus on Canada's national defense priorities outside of the space domain. Here to discuss the future of Canadian defense, Mike Greenlee, CEO of MDA Space. Mike, thanks very much for joining us.
Good afternoon. Good to see you.
Why do the spinoff? Why create 49 North?
Just to be able to respond to the growing focus on defense. MDA Space has over 50 years of history in the defense sector, both in space, of course, but also in non-space, in Army, Navy, Air Force, and joint communications activity. And so we wanted to be able to take the non-space aspect, put it in 49 North, create a wholly owned subsidiary with its own president in Joe Armstrong, and be able to focus that in the market to be able to build Canadian systems and to be able to partner with international partners to bring solutions to the Canadian defense market.
And what will you be focusing on with defense? What will be your target?
Our history in defense in the non-space area includes autonomous systems. We've been one of the premier providers of unmanned aerial vehicles to the Canadian Army and Air Force over the last year since Afghanistan. In command, control, communication systems, in intelligence, surveillance, and reconnaissance systems, sensors, and in-service support to those systems once deployed.
And there are some, I imagine for you, there must be some tremendous opportunities with the expansion of spending on defense. How do you see this growing, and what opportunities do you see? Is it going to be focusing on those unmanned, or will there be one area of the ones you just mentioned that will get more focus than the others?
Yeah, certainly unmanned will get a fair amount of attention. We're busy these days delivering the remotely piloted air system, the RPAS system for the Canadian Air Force, and the Royal Canadian Navy's unmanned vehicle program, which we recently won and are delivering on. We'll look for more opportunities in that area, which will certainly be a focus of all defense expansion around the world as the various defense forces continue to expand. So we'll be looking to leverage that position in Canada to do more. But also in sensors, we're building sensors for the next generation river-class destroyers, the next generation surface ships for the Canadian Navy, and command, control, and communications as we bring secure communications and sensor integration to various systems. With Canada's focus on increased sovereignty and security, it'll be very important to be able to look at all of our sensor environment, how those sensors come to create a picture of Canadian security or military security internationally, and then to be able to provide the necessary secure communications for military operations, both across Canada and in the north, and internationally when deployed.
And I imagine the unmanned and the sensors, and that must be a huge aspect of defending the north. They seem like a natural fit for it.
For sure, it's a natural fit. On the space side of the business, the MDA Space side of the house, we recently announced in the fall a strategic agreement with the Department of National Defense and with the Telesat Corporation for us to be able to provide the satellite-based communications for the military into the future for Arctic communications in the north. That'll be a very, very large program. In this new 49 North activity, we'll be able to provide a range of different autonomous operations, sensor types, and communication activities for northern operations on the Navy, Army, and Air Force side of things.
And a big push with this defense spending is keeping Canadian companies, obviously yourself. Are you working with any other Canadian companies, or will you be trying to help develop other Canadian companies in this field?
I think it's really important for the Canadian companies to work together. We've just recently announced on Monday by the Prime Minister the defense industrial strategy for the country. I was certainly there at that announcement. It was a great announcement. We've been looking for this type of defense strategy in the country for decades now. In my 35 years of experience, this is a unique moment to be able to see everything come together to have a defense industrial strategy for Canada. And within that, there was the elements of build first in Canada, then partner internationally, and then buy when we have to. And on the build side, I think Canadian industry needs to work together to be able to make sure that we can collaborate and deliver the systems that the Canadian military needs. So we'll be looking as one of the larger defense prime contractors in Canada to be able to partner with other Canadian industry, to be able to build the Canadian military capacity, the systems that our military needs, to be able to perform and expand their role, in addition to partnering with international players to bring their capability into Canada and deliver it within Canada to create jobs and sovereignty within the Canadian environment.
Now, is the talent and the capabilities in Canada, do you feel?
I do. We've been very successful at hiring strong engineers over the last several years. In 2022, MDA Space hired over 700 people. In 2023, over 850. In 2024, over 900. So we've definitely demonstrated that we can attract engineering talent to our corporation and to the defense and space sectors. We will continue to do that. 49 North will be hiring as it goes through 2026 and starts to expand. And we will be teaming with Canadian and international partners to be able to create the industry consortiums necessary to deliver on Canada's expanded defense industrial spend.
All right, just one last question just on MDA Space. Latest on the EchoStar deal around that. There's a possible class action lawsuit. Can you talk to any of that?
Just that we'll be, defending ourselves well against that, defending against that event. Everything was done properly there, and we will aggressively be defending ourselves.
Okay, we'll leave it there. We appreciate you joining us, Mike. Thanks very much.
Thank you.
Mike Greenlee is the CEO of MDA Space. Still ahead, the CEO of Alamos Gold joins us as the company reports its fourth quarter earnings and tells us about its growth outlook. Alamos Gold reported its fourth quarter results with record free cash flow. Though production came in lower than expected after a challenging year at its Canadian operations. Joining us now is the company's CEO, John McCluskey. John, thanks very much for joining us.
It's a pleasure to be here.
Let's talk about the positives first. Where were your standouts for production?
We had a great year at Mulatos, and that marks something like 20 years of production at Mulatos. We've produced close to 4 million ounces at that mine over that time. We've probably made in the order of $800 or $900 million in profit. That's been an exceptional operation for us. We had a great year on exploration. It's been the 7th consecutive year where we've expanded our reserves net of depletion. And we did particularly well at Island Gold, where we had a significant increase in reserves. So reserves were up over 16 million ounces across the company, and 8 million of those ounces are at our Island Gold complex. So that's been just a tremendous success for us. And despite the fact that we didn't produce quite as much as we had intended, we still hit record revenue, record free cash flow, record earnings, and that was, we still did quite well. We produced 545,000 ounces of gold at good costs, and that accounted for a very strong cash flow for the year.
And how is Mulatos looking? You said it's been great for 20 years. Where do you see it going over the next while?
Well, the big transition is coming up now. We've been investing quite heavily in development of a new deposit down there called PDA. It's higher grade underground, and what we've typically been mining is low grade open pit up till now. but we're looking at something like just over 1 million ounces in reserves at the PDA zone, and we're building a new mill, and we'll have that in production by 2027. That'll be the year we transition from open pit oxides to a high grade underground mining. So we're looking forward to that. We were one of the only companies in Mexico to get a permit of any consequence last year, and it was for the development of that mine. And it's going to mean that Mulatos will continue to produce well into the end of the 2030s, and I believe beyond.
Okay, and then the Island Gold District, there's an expansion. You call it transformational. What are the changes?
So we acquired Island Gold when it was a very small deposit, and back when it wasn't really very fashionable to do so, we were exploring very aggressively there. And we've taken reserves from under 1 million ounces to over 8 million ounces in that district. And that's net of close to 2 million ounces of depletion that we've mined in that district over time. So it's been just phenomenal growth. There's very little to compare with it. In fact, I was looking for an analogy for it, and the closest I could come to was the Golden Giant mine in Hemlo it was discovered in the 1980s and produced through the 1990s. And that's the only thing in Canada that shows anything close to what we're achieving here. It's very high grade. It's just under 11 grams. And we've really expanded the operation. We've been investing in a big project, putting in a shaft with the idea of going from ramp-driven mining to shaft-driven mining. It's a much lower cost, much more effective way to go. And we're going to be there by the end of this year. The shaft is almost at shaft bottom now. We'll have all the infrastructure completed by the year end. And that mine will transition towards the end of this year from a ramp operation to an underground operation. So that's going to drive the higher production and the lower cost.
And that's so reason for optimism for the Canadian operations and most of the challenges behind you now?
Well, the challenges we faced were really temporary. We were dealing with a very significant cold climate. We basically had one of the coldest winters in this region for something like 20 years. It's as long as anybody can remember. So we had lots of snowfall along with that cold weather, and it's the snowfall that's the biggest problem. It caused the road closures, and that really has an impact on the operation. It will be less of an impact going forward because ultimately we're going from running the primary mill at site, what's called the Magino Mill. We're running that off of compressed natural gas, and that means we're dependent on regular deliveries of that gas. We get 2 deliveries a week, and if it doesn't come in, we don't have any fuel. But going forward, we're hooking up to grid power. We've got a power line project that's underway, and that'll be completed towards the end of this year. Okay. And we'll no longer be reliant on those deliveries. So that's going to make a very significant impact on that operation, make us less vulnerable to weather conditions.
All right. And what's the latest on you had to refile your financial statements in December?
That was actually a non-issue. It was actually our annual statement, and it was essentially a glitch in the software that was used by our auditors, and there was some miswording in their audit opinion. So we had to refile it with the correct wording. That's it. There was no change in our numbers or anything like that. It was our financials were as we originally filed them. We filed them literally 2 hours apart. So the numbers were all the same. It was just the wording in the audit opinion had to change.
Okay, I appreciate you clarifying that. You returned almost 81 million to shareholders in 2025, doubling 2024. What's 2026 looking like when it comes to dividends and buybacks?
Well, we just announced a pretty significant increase in our dividend, and that's not something a company would typically do when they're going through a period of fairly heavy capital expenditure, which we're going to be in for the next 3 years as we build out this Island Gold expansion project, plus our new Lynn Lake mine, which will start construction in the spring. So that's not typically a time you'd expect a company to be increasing the dividend, but we bumped it by 60%. So we're taking up from about 45 million a year to about 67 million a year.
Okay.
And I don't think that's going to be the last dividend increase you see from us.
John, I don't mean to cut you off, but we're out of time. Thank you very much for joining us today.
It's a pleasure. Thank you.
John McCluskey is the CEO of Alamos Gold. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thank you very much for joining us. Have yourself a great afternoon.